China's trade balance is out in a few hours' time and will underscore the size of the export surplus the country is running as its economy powers ahead. The value of the Chinese currency and the export advantage it delivers is the source of a growing rift with the United States. Talk in Washington is of the nuclear option of trade barriers if the yuan is not allowed to rise. Treasurer Wayne Swan used a speech overnight in New York to call for restraint, saying a round of trade sanctions would hurt the global recovery. I'm joined now from Hong Kong by Glenn Maguire, Asia Chief Economist at Societe Generale. Thanks for joining us.
Thank you.
So we've just heard that China's latest trade account figures for September are due out in a few hours' time in the morning. What are you expecting?
Look, I think what we're going to see is a modest widening in China's trade surplus, but this has nothing to do with the level of the currency. Most of the goods China purchases and most of the goods China sells are goods which are sold in global auction markets denominated in US dollars. And what we're seeing with China is where most of the growth in trade is coming is not with the US, it's not with Europe, it's actually with other emerging markets. So though we're looking for a marginally wider trade surplus, around 25 to 30 billion US dollars on the month, we have to remember that this is well down on the full-year surpluses of around 300 billion US dollars that we were seeing before the crisis. So there has been the sharp narrowing in China's trade surplus that's come about from a weakening in external demand.
So is there a risk of continued growth in exports?
Look, I think what you are seeing is China's exports are growing to other emerging markets. Also, what we've seen in the US is as long bonds have fallen, as mortgage rates have fallen, as there has been a dynamic of refinancing, you have seen a pickup in expenditure on your very basic durable goods like clothing and footwear. And these are types of goods that tend to be purchased out of disposable income, not on credit. The credit dynamic to finance consumption, which was such a feature of the US economy and other developed economies, has all but disappeared. So any strength we're seeing in Chinese exports really is coming through at that lower end of the durable goods market.
Now, I'm not sure if you've seen these reports, but there are reports out tonight or late this afternoon that China has told its biggest banks to increase reserves in a new move to control lending, obviously signs that they're still worried about inflation. What will, if this is true, what impact or what effect will this have on interest rates and the yuan?
Oh, look, it definitely is true. The major banks have been instructed to lift their reserve requirement ratio by 50 basis points, but importantly, it's for a period of 2 months. So what we're seeing is really a fine-tuning of China's very generous liquidity policy. China continues to promote very strong bank lending to target infrastructure and investment projects and to finance those via the major state-owned banks. What we are seeing with this, what you'd call a micro move in terms of the overall thrust of macroeconomic policy, is essentially trying to avoid that liquidity flowing into the property sector. So we shouldn't view it as a tightening measure per se, and likewise we shouldn't sort of view it as an interest rate differential argument in favour of the yuan. I think the yuan continues to be driven by how China perceives its internal balance, that is China's growth relative to its external balance, growth in the rest of the world. And as growth in the rest of the world remains relatively modest, we shouldn't be looking for any big moves in the yuan.
There are reports, the currency war between China and the US has been well documented. It seems to get worse by the day. China is facing the fastest inflation in almost 2 years. Has it done enough to increase the value of the yuan? Or, will the valuation increases stop now?
Look, I think with the yuan, we have to remember that China's inflation problem is not an imported inflation problem. It's a domestically generated one. What we're seeing is the price of foods, the price of domestically produced goods is picking up. We're also seeing very strong wages growth in China. Now, for the US to respond to what they perceive to be an undervalued currency by putting tariffs in place would be one of the most foolish economic policies you could ever see. Over the past 2 decades, the US has progressively and almost completely outsourced its manufacturing sector to Asia and China. And now its response to this is we're going to put a tariff on these goods, hence make them more expensive. The ultimate loser is the US consumer. It's incredibly foolish economics.
They're the ones who have been wanting all these goods, and now they're sort of saying they can't have them. Look, Wayne Swan last night in New York was talking about that, saying, warning people to be rational. He did say that, and I quote, that developing nations need a faster rate of growth in domestic demand, while developed countries need to undertake reforms that increase national savings. Do you agree with this, and what evidence is there that this is happening in China?
Look, I do agree with that, and I think, the key warning that we can take from all of this is obviously, again, from the US, the Smoot-Hawley tariff acts immediately following the recession of 1929 to 1932. It was the collapse in world trade that came from tariffs, largely driven by the Smoot-Hawley Act, that tipped what was a recessionary global economy into a depressionary global economy, and policymakers have not learnt that vital history lesson. Returning to Wayne Swan's point about, developing nations need to grow their internal demand more, that's exactly what we're seeing. China and India have put in place stimulus packages that far surpass anything we've seen in the US. Asia is increasingly turning to investment in infrastructure. China and India, we're really starting to see a true domestic consumption dynamic emerge. What we need to see on the flip side of that is fiscal consolidation and public debt repair in the developed nations. This entire notion that, Brussels and Washington wave their finger at China and Asia and say, you need to save less, is complete nonsense. It was a lack of savings in the first place that got us into the entire mess we're in. So it's more, there has to be a genuine fostering of investment and then consumption in the developing world.
Glenn Maguire, we're going to have to leave it there, but thank you very much for joining us this evening.
Thank you.